Big Canadian banks are pulling credit lines and cutting jobs. Is this a sign of what's to come? We're going to get into it and also look back at what happened in the US in 2008 to see if we can draw any similarities. So as the housing market implodes, the mainstream media is finally starting to say the quiet part out loud, which is that the recession in Canada has already begun. And guys, we've been talking about this for a long time on this channel. The recession already started. We know that the unemployment rate has been going up and up and up and up. We know how bad the economy is, but you don't need to hear it from economists who are lagging way behind everything. So they're now saying that Canada is in a recession. Canada's economy likely in the early stages of a recession, according to forecasters, as unemployment rises and exports fall because of a trade war with the United States. Economists surveyed by Bloomberg say that output will shrink 1% on an annualized basis in the second quarter and 0.1% in the third quarter, which constitutes a technical recession. And here's the other thing. Scotiabank's profit dips as it prepares for potential turbulence ahead. So you've got even banks like Scotiabank that are coming out and they're saying the quiet part out loud too, that things are not that great. So they're trying to make it so that it sounds better than it actually does, because they always have to do that to their shareholders. They always have to try and appease their shareholders. I mean, that's what they earn money on. All these big corporate CEOs are getting paid stock bonuses, and it's based on stock performance. So while we have not seen a meaningful deterioration in credit, our base case forward-looking indicators have worsened. And you know, you can quite easily see why that might have happened, because I saw that Red Pill Rick put this out on X. And when you look at what's happening with the delinquency rates across Canada, they are rising substantially. And let's face it, guys, we've been into it. Ontario's at 2%. Let's just take that one. If we go over to Warren AI again, you can see here that provisions for credit losses here, they're very, very low. The Bank of Nova Scotia actually is one of the highest for their provisions here, but it is still way less than 1%. It's not even 0.5%. It's 0.19%. So that's not a lot when you really think about it. Remember when they were pulling credit lines in 2008 and 2007 in the United States? Well, that is actually starting to happen in Canada, guys, as well. So the banks ain't your friend. They're starting to take away HELOC access overnight without warning. Those 3 pre-cons you bought thinking you could leverage on top of each other are now fucked. What you going to do now? These banks were giving out dollars like candy a few years ago, and now they're taking it away. And that's very interesting, because you go back to 2008, just take a read of this article, which is from April 21st, 2008. It wasn't declared at this time in 2008, but the US was in a technical recession at that time. So in recent months, tens of thousands of homeowners like Carr have been shut off from their equity as lenders try to stem losses from subprime mortgages and other high-risk loans. As of September, delinquencies on HELOCs were up 47% year over year. The numbers are expected to be worse in 2008. In response, Countrywide, which went bankrupt, has already suspended an estimate 122,000 lines, many in high foreclosure states. So you've just got to think about it. And all of the banks were doing this, and now they're starting to do it in Canada. And I also went to Investing Pro and I asked Warren AI, well, what was going on with earnings at that time? And when Q1 earnings for 2008 were reported, most of the banks were still profitable. It was only Citigroup that actually posted a loss for that period, and a lot of the income was down substantially. But the fact is, a lot of those banks remained profitable at that time, and there was probably no kind of warning signs going off in people's mind that there was a banking crisis on the horizon. And that's the thing. Banks, they can manipulate and hide things for a long, long time. CIBC is axing 500 plus jobs at its Toronto credit card call center. The roles are being shipped out out to Central America. Corporate profits up, jobs out for Canada. And, you know, this is happening more and more, and it's all to do with cost cutting. And unfortunately, I do think it's wrong that companies are allowed to buy back their own stock. I mean, you've got a lot of these banks that are coming out and saying that they're going to buy their own stock. I mean, that is literally share price manipulation, in my opinion. But they shouldn't be allowed to do that, because the reason they do that is to inflate the prices, which benefits the people at the top. As I said, they're targeted on the performance of the stock and not the company necessarily. And that means that basically, instead of prioritizing putting money into a company and expanding growth and operating into new different services, they just buy their own stock. I mean, it's just absolutely crazy when you really think about it. And another thing I wanted to show you, if we go back to 2008, is if you look at what happened in 2008, you know, delinquency rates, they were creeping up. They hit a low in 2006 at 1.4%, started creeping up. And I would say we're around here, Q4 2007. We're sort of in that area right now in Canada, because when you look at delinquency rates as well, they're starting to surpass a lot of the times in the past, going back a couple of decades. And if you look at where you were in 2007, you had to go back pretty much over a decade to the 1990s in order to get delinquency rates that were higher than that. Whereas now you're going back to that 2008, 2009 with the Ontario mortgage delinquencies, for instance, and everything that's happened there. So it's very interesting. Hudson Bay will lay off 8,347 employees. So just tag that. That's a lot of people that are being let go from the Hudson's Bay. Obviously pretty sad that that retailer is going under, but I don't know, if you've been in one of those stores in the past 3 years, it was like walking into a ghost town. I mean, there was nobody there, and it was just obvious, I think, that that was probably going to happen. And then you've also got credit default swaps on US government debt are hitting some of the highest levels since 2008. And this isn't necessarily an indicator that there's going to be a default in the US. Again, it just goes to show financial crisis risk is once again spiking and spiking and spiking. I mean, the US is always going to print money versus defaulting in any of these situations, and it will be like that in the future as well. And unfortunately, that is one of the privileges that the United States has of having the world's reserve currency. Canada doesn't have that privilege. So when things get bad in Canada, Canada has to face up to the fact that it could see yields absolutely skyrocketing, and it could lose control of the currency and the bond market if it's not careful. There have been big economies that have had downfalls like that in the past, like Argentina is another great example of that. And then why did I call a full-blown recession? Because there are no jobs. And again, just look at some of these stories. How do you survive? My brother can't find a job. I can't find a job, and I'm still jobless. It's now June. They've been hunting for months and months and months, and they're just saying how dead the market is. The guy says he's put in like 400 job applications this year, just wants a part-time job. I mean, it's absolutely crazy. Some of the stories, people have like 7 years in retail experience and they still can't get a job. I mean, this is just showing you how bad the economy is. And then you just have to think, well, how are these people going to be able to afford rent? How are these people going to be putting food on the table? And that's exactly the reason that you see more and more people that are going to food banks, because more and more people are struggling to survive in this Canadian depression that is unfolding before our eyes here. And we all have to kind of think that obviously with what the banks are doing right now, I'm not saying that they're not a safe place to put your money, because I think they'll always be bailed out in the end because they're too big to fail. I don't think any government would let the banks fail in Canada, so I don't really think there's a risk of that. You've just got to look at how well capitalized they are, and they're not really that prepared for a big storm ahead, even though that's what they keep saying they're going to do. And the same thing in 2008 was happening, where hiking loan loss provisions at US banks, and obviously how did that end up? They couldn't cover with those loan loan loss provisions, and they had to get bailouts from the government. So I'm not saying that's what's going to happen, but it's just incredibly similar. I mean, they always say history doesn't repeat, it rhymes, and it certainly rhymes when it comes to this. So anyway, guys, I want to thank you so much for watching this video. If you've enjoyed this video, I'd highly recommend that you check out this video here. If you want to get Warren AI, which is part of Investing Pro, then check out the referral link below, and I will see you in the next one. Take care.